Welcome to the Deep Dive, the show where we take stacks of information and really pull out the important stuff, giving you a shortcut to being truly well-informed. Today, we're unlocking the secrets of a really crucial financial maneuver, one that can significantly impact your investment portfolio. We're taking a focused look at the Savvy Investor's Playbook for rights issues. Now, whether you're already a shareholder, or maybe you're looking for new opportunities, understanding rights issues, well, it can be a game changer. We'll unpack what they are, why companies use them, and crucially, what your options are as an investor. And while these principles are pretty universal, today we'll be illustrating them with some really clear examples from the Saudi market that demonstrate these concepts in action.
It's definitely a topic that, often seems complex from the outside, but it's essential, really, for any investor navigating the market. What's fascinating here, I think, is how a company's need for capital directly translates into specific actionable decisions for you, the shareholder.
Absolutely. And this deep dive is brought to you by Shares247.com Learning Community, your free go-to resource for empowering financial knowledge. Okay, so let's unpack this then.
Yeah.
At its core, what exactly is a rights issue?
Well, basically, a rights issue is a mechanism companies use to raise capital. They do this by inviting their existing shareholders to subscribe to new shares, and often these are at a discounted price. It's based on something called a preemptive right, which means you, as an existing shareholder, you get the first opportunity, the first dibs, really, to buy these new shares before they're offered to anyone else. It's truly about giving you the chance to maintain your ownership percentage.
Okay. That's an interesting point about maintaining ownership. So it's not just about raising money, but doing it while respecting who already owns the company.
Exactly. That preemptive right is key. Unlike, say, a public offering where new shares might be sold to anyone, a rights issue targets existing shareholders first. This helps preserve the ownership structure, and, it can actually be less costly for the company, too. Fewer underwriting fees sometimes. Consider ACWA Power, a Saudi-listed joint stock company. They offered over 33 million ordinary shares at an offering price of SAR 210 per share, that's Saudi rials. This was part of a really significant capital increase, and it shows how these large-scale companies leverage rights issues while, prioritizing their current investors.
So companies have different ways to raise money. Why pick a rights issue specifically? What does that signal to us as investors?
Good question. Companies typically offer rights shares for, various reasons, but they all revolve around needing to raise capital. This could be for financing expansion plans, maybe. We saw that with Walla Cooperative Insurance, they plan to use the net proceeds to support growth. Or it could be for paying down debt, funding new projects, or even improving their solvency margin and maintaining credit ratings, which Walla also aimed to do.
Okay, so lots of potential reasons. And beyond the company's immediate need, are there advantages for the company itself? And how might those benefit shareholders, maybe indirectly?
Yeah, definitely. For the company, it's often a more cost-effective way to raise funds compared to, say, a full public offering. Less hassle, potentially lower costs.
Yeah.
And importantly, it can help avoid dilution of control for major existing shareholders because they get that option to maintain their proportionate stake.
Right.
So from an investor's viewpoint, it kind of signals that the company is trying to be mindful of its current shareholder base.
Okay, that makes sense. But what if a company is facing, say, liquidity challenges? You mentioned Amianted earlier.
Yeah.
How does a rights issue fit into that kind of strategy?
Right, that's a critical point. Amiantit's prospectus, for example, it indicated liquidity ratios that suggested difficulty covering short-term obligations and securing letters of guarantee. Pretty serious stuff. In that kind of scenario, a rights issue could be absolutely crucial. It's a tool to inject necessary capital, strengthen the balance sheet, and just ensure operational continuity. It directly addresses those specific liquidity risks. Often it can be a lifeline when maybe other funding sources are less accessible or just too expensive.
Got it. So diving deeper now into the specifics, what are the key terms, the jargon, that we as investors really need to get our heads around to navigate a rights issue effectively?
Yeah, there's definitely specific vocabulary. It's essential. First up is the eligibility date, sometimes called the record date. This is the cutoff. Only shareholders who are registered in the company's shareholder register by the end of the second trading day after the Extraordinary General Assembly, the EGM, that approves the capital increase, only they are eligible for the rights.
Okay, so timing is critical there.
Very. Then there's the rights issue ratio. This tells you how many new shares you can actually subscribe to for each existing share you own. Tarquin's prospectus, for instance, mentioned an approximate ratio of 0.6456 rights for each one share, gives you a precise number.
Right.
Next, the offering price, or issue price. That's the price the new shares are offered at. ACWA Powers was SAR 210, Taqueen's was SAR 10 per share, and crucially, this is usually at a discount to the current market price.
That discount seems important.
It is, and related to that is the indicative value of a right. This is basically the theoretical value of the right itself, not the share. It's calculated as the difference between the market value of the company's stock during the trading period and that offering price. So, using Taqueen again, if their stock closed at SAR 15 and the offering price was SAR 10, the indicative value of the right might be around SAR 5. That's the value of the right to buy the share.
Okay, the value of the option itself.
Exactly. Then you have the trading period. This is a specific window when the rights themselves can be bought and sold on the exchange, like Tata Wool, the Saudi exchange. Each right gets its own separate ticker symbol during this time.
So the rights are traded like stocks for a while.
Precisely. After that comes the subscription period. This is when eligible investors can actually exercise their rights and subscribe to the new shares. Pay the money, get the shares. And finally, the rump offering. If there are any unsubscribed shares left over after the main subscription period, they get offered to institutional investors. This is the rump offering, and it's usually at a price no less than the original offering price.
Gotcha. That's a lot of terms, but very clear. So with those crucial terms laid out, let's walk through the actual timeline, step by step, from the first announcement to those new shares actually landing in your portfolio.
Right. The first step is always the company's official disclosure, the announcement. This is critical because it contains all the proposed details, how many new shares, the offer price, the resulting increase in share capital. For ACWA Power, this announcement and then getting the approvals from the CMA, that's Saudi Arabia's financial regulator, and Tadawul, and of course the EGM, those were all key milestones. Have to get those ducks in a row.
Makes sense. Now, let's talk about that trading period again. You said the rights themselves are traded. This sounds like where things get really interesting for both current and potential investors. What happens then?
Yeah, it's a dynamic phase. During this period, the rights, they're listed and traded on Tadawul with their own unique symbol, like a mini stock for a short time. This gives existing shareholders several options. They can sell all or maybe just part of their rights on the exchange. Or they could buy additional rights through the exchange if they want more shares. Or simply do nothing with them right then. And importantly, new investors also get the chance to buy rights directly through the exchange during this period. It's their way in.
Okay, so you mentioned doing nothing. If you don't sell your rights during that trading window and you don't subscribe later, what's the direct financial hit? What happens?
Well, that's the risk. If you don't sell your rights before the trading period ends, and then you also choose not to subscribe, you could face a loss, or at least a decrease in the value of your investment portfolio. Because those rights, if they're not exercised, they'll just expire worthless. Poof. They essentially become valueless.
Right, okay, use it or lose it, basically. So
Mhm.
once the trading in rights is finished, it's time to actually subscribe, you said. How does that part work?
So this is the subscription period. This is when you exercise your rights and actually subscribe to the new shares, pay the offering price. Your broker plays a key role here. They facilitate the whole process. Usually it's done electronically now. And it's important to note, if you bought rights during the trading period, you'd need to await for those to settle in your account, usually a couple of business days, before you can then subscribe for them.
Okay, makes sense. So after we've subscribed, paid our money, what happens next? When do we actually see those new shares?
Right. So after the subscription period closes, there's a process of share allotment, basically distributing the new shares to everyone who subscribed. These new shares will then be listed and become available for trading on the exchange, just like the original shares. A key point here is that the company's share price is actually adjusted by the exchange. This happens before the start of trading on the day right after the EGM that approved the capital increase. It reflects the dilution effect from all the new shares coming into the market. The pie is cut into more slices, so the price per slice adjusts.
Ah, okay, the price adjusts automatically. Good to know. Now, what about those leftover shares you mentioned, the rump offering? Does the size of that rump offering ever tell us anything, like about market confidence? Or is it just tidying up?
That's an interesting question. So the Rump offering handles any shares that weren't subscribed for initially. They're offered to institutional investors. These institutions submit bids, and the shares are allocated usually based on the highest offer as long as it's not below the original offering price. The money raised goes to the company. Now, if the price paid in the rump offering is higher than the original offering price, that excess amount gets distributed proportionally back to the eligible people who didn't subscribe or sell their rights.
Oh, really? So you might get something back even if you did nothing.
Potentially, yes.
Yeah.
But it's really important for investors to know that if there is no excess, if the rump shares are sold at exactly the offering price, then you might not receive any consideration at all. It's not guaranteed money back. As for what it signals, yeah, a very large rump offering could, in some cases, suggest maybe a lack of enthusiasm, either from existing shareholders or the broader market. Perhaps they didn't find the offer attractive enough. So it's definitely something analysts might look at.
Right. That makes sense. Okay, so with this step-by-step understanding, let's get practical. What are the actual choices facing an investor when a company announces a rights issue? What are the paths you can take?
Okay, if you're an existing shareholder, you basically have four main paths. First, exercising your rights. This means you buy the new shares offered to you at that discounted price. The big benefit here is maintaining your percentage stake in the company. You avoid having your ownership diluted.
Right, keeping your slice of the pie the same size.
Exactly. Second, selling your rights. If you decide not to subscribe, maybe you don't have the cash or don't want more shares, you can sell your rights on the exchange during that trading period we talked about. This lets you monetize those rights, get some value back, instead of just letting them expire worthless.
Okay, so turn the right itself into cash.
Precisely. Third, buying more rights. Maybe you really believe in the company and see this as a good opportunity. You can actually increase your investment by purchasing additional rights on the exchange during the trading period, on top of what you were initially allocated. We saw with Al Omran, for instance, the prospectus mentioned, an investor could sell part of their rights and subscribe for the remaining, or buy more. Flexibility there.
So you can boost your holding.
You can. And finally, the fourth option, taking no action. This means you neither exercise your rights nor sell them. You just let them sit there. The consequence here is pretty clear. Your rights will expire, potentially leading to a direct loss or decrease in your portfolio value, and your proportionate shareholding in the company will be diluted.
Okay, so it really sounds like taking no action is almost always the worst option here, isn't it? Are there any, I don't know, super rare exceptions where maybe for tiny holdings the cost or hassle might outweigh the benefit? Or is it truly always better to either sell or exercise?
That's a great question. And honestly, it's almost universally detrimental to do nothing. Even for very small holdings, while maybe the admin hassle of selling feels disproportionate to the tiny value you might get, letting them expire is a guaranteed loss of whatever that value was.
Right.
So yes, inaction typically leads straight to a lost opportunity or just a direct loss of the value embedded in those rights.
Okay, clear message there. Now, what about someone who isn't an existing shareholder? They see this happening, maybe they like the company. How can they get involved?
Yeah, for new investors who want in, the path is pretty straightforward. You can enter the picture by purchasing the rights directly during that trading period on Tadawul, just like an existing shareholder could buy more. Once those rights settle in your account, you can then proceed to subscribe to the new shares through your broker using those rights you just bought. You effectively step into the shoes of an eligible shareholder at that point.
Got it. So the trading period is the entry point for outsiders. Okay, like any investment decision, there are upsides and downsides. Let's try and get a balanced view. What are the potential advantages and disadvantages for us retail investors when we participate in a rights issue?
Sure, let's start with the pros. The most immediate advantage, usually, is acquiring shares at a discounted price compared to the current market value. Like we mentioned with Paquin, their offering price was SAR 10. If the market price was, say, SAR 15, that's an immediate potential paper gain right there.
Yeah, that discount is definitely attractive. But beyond just getting shares cheaper on day one, what are the other strategic upsides for an investor?
Well, it provides a clear opportunity to increase your holding in a company you already believe in, or perhaps one you've identified as promising, especially if you think that discount offers a really good entry point for adding more shares.
Right.
And as we keep saying, for existing shareholders, participating is absolutely crucial for preventing the dilution of your existing shareholding. If you maintain your proportionate stake by subscribing, your slice of the company's pie, your influence, your share of future dividends, it all remains the same proportionally.
Okay, those are some strong positives. So what about the other side of the coin? What are the potential pitfalls or risks we really need to be aware of?
Right, the downsides. Firstly, there's the obvious financial burden of subscribing. You need to have the cash available to exercise your rights. That might not always be convenient or liquid for every investor, depending on their situation.
Yeah, you need the funds ready to go. And beyond that immediate cash outlay, what about market-related risks? What often catches investors off guard during these things?
Well, there's definitely the risk of share price volatility both during and after the rights issue. Things can get choppy. Remember that indicative value of the right? It's directly tied to the share price. And as Alzer noted in their materials, the permissible daily fluctuation range for the rights trading can actually be wider than for the underlying stock.
Oh, wow.
Yeah, so that can lead to potentially substantial losses for speculators if they misjudge the market direction during that short trading window. It's not for the faint of heart.
High potential for swings then.
Definitely. And of course, the flip side of maintaining your stake is that if you do not participate, there is a clear potential for dilution. Your existing shareholding gets smaller in percentage terms, reducing your overall ownership, your future voting power, your slice of future dividends per share.
This brings up a really critical point, I think. What's the single most important piece of due diligence an investor should do when a rights issue is announced? Where should they focus their attention?
This is absolutely key. It's paramount to understand the company's reasons for the rights issue. Why do they need the money?
Right. Is it for exciting growth opportunities? Or is it more defensive, like managing debt or covering accumulated losses? This is probably the ultimate nugget we're digging for here. Because while companies might list various standard reasons, a savvy investor needs to look deeper. A rights issue to fund growth? Well, that can be a positive sign, right? Expansion, new markets.
Yeah, sounds good.
But one that's primarily for debt repayment or, like we saw with Taquin, to cover significant accumulated losses. They had losses reaching over 54% of their capital. That could be a flashing red light. It might signal deeper financial distress.
Big difference.
Huge difference. Conversely, you had Voila aiming to use proceeds for growth and to enhance its solvency margin, kind of a mix. And then Amiance's prospectus, that highlighted liquidity risks and even non-compliance with certain accounting standards that strongly suggested their rights issue stemmed more from financial distress than growth ambitions.
So understanding the why is crucial context. Absolutely. And beyond the specific reason for this rights issue, you also need to be aware of broader company risks that could still impact the value of your investment, new shares, or old. This includes things like ongoing liquidity risk. Amiantit explicitly stated their ratios indicated difficulty covering short-term obligations. That doesn't just disappear overnight. There are also operational and IT risks. Etihad Athib, for example, noted risks related to IT system failures or security breaches that could disrupt services, hit revenue. Regulatory compliance is another big one, especially in sectors like finance or telecom. Companies from ALSA to Etihad Athib operate under strict rules. Non-compliance, like the fines Etihad Athib faced from the CST, can lead to penalties, reputational damage, and impact financial health. Don't forget reliance on key personnel. Both Alser and Wallah highlighted this risk losing key people can hurt. And of course, lawsuits and legal claims. Taquin noted ongoing lawsuits could have a material adverse effect. And finally, just the broader economic performance. Companies like Alsar and Wallah acknowledge their future is tied to the kingdom's economic conditions, global factors, oil prices for some. These macro risks matter. And one last word of caution coming directly from Also's materials. They explicitly warned about the risks of pure speculation in rights issues, noting that potential for substantial losses because of those high daily price fluctuations we talked about.
Okay, a lot to consider there beyond just the rights issue itself. So as we bring this deep dive towards a close, let's focus on actionable steps. What practical things can you do to leverage this knowledge and make informed decisions? How do you stay on top of these things?
Well, the key is always refer to official sources. Don't rely on rumors or forums. Information about upcoming rights issues is typically found right on the Tadawul website, the exchange's site, and through official company announcements filed there. You'll often also get notified directly, maybe via SMS messages from your broker or other intermediaries. And services like Tadawulati, provided by the Depository Center, can also push notifications.
Okay, so stick to the official channels. And my broker, you mentioned them facilitating things. How crucial are they in this process? And what should I look for in my brokerage firm when it comes to handling rights issues?
Your brokerage firm is absolutely essential here. They are the ones who actually facilitate your participation. They allow you to submit your subscription applications, usually electronically now through their trading platforms or apps. They also process your buy and sell orders for the rights themselves during the trading period. And ultimately, they ensure the new shares, if you subscribe, are deposited correctly into your investment account.
So what makes a good broker for this?
Look for a broker with really clear communication. They should notify you promptly and explain the steps. Easy-to-use platforms are a must. You don't want to be struggling with the interface during those critical periods. And responsive customer service is key. In case you have questions or run into issues, they should be able to guide you through the process smoothly.
Good advice. Okay, thinking about what our listeners might still be wondering, let's tackle a few common questions in a quick Q&A format. First up, can you sell part of your rights and then subscribe using the remaining part?
Yes, absolutely. That's quite common. As we saw with the Alloran example, an investor can definitely sell a portion of their rights on the market and then use the rights they kept to subscribe for shares during the subscription period. You just need to make sure the sale settles before you try to subscribe with the remainder.
Okay, good flexibility. Next question. If someone buys shares of the company on the same day as the Extraordinary General Assembly, the EGM that approves the rights issue, will they be eligible for the rights?
Yes, they will. Eligibility is based on being registered in the shareholder register by the end of the second trading day following the EGM. So even if you buy on the EGM day itself, you'll meet that cutoff and be eligible for the rights. One small caveat, though. You wouldn't be able to attend or vote in that specific EGM for the capital increase because the record date for voting eligibility would have passed earlier. But you'll get the rights.
Ah, okay. Subtle but important distinction. What about investors who have multiple portfolios, maybe with different brokers? How are their rights calculated and distributed?
Good question for people with complex setups. Your total rights entitlement is calculated based on your total shareholding across all portfolios combined. Then the rights are distributed across your different portfolios proportionally based on the percentage of the company's shares that you hold in each one. If there are fractional rights involved in the calculation, these fractions are aggregated across all your portfolios. If the total of those fractions adds up to a whole number, an integer or more, that whole number of rights will typically be added to the portfolio where you hold the largest number of rights already.
Okay, so it aggregates intelligently. Next.
Yeah.
What determines the opening price of a right when it first starts trading on the exchange?
Right. The opening price isn't random. It's determined by the difference between the closing price of the company's original share on the day before the right begins trading and the offering price of the new shares. So using that TACWIN example again, if the stock closed at SAR 15 the day before rights trading started and the offering price was SAR 10, the right would theoretically open at SAR 5, 15 minus 10. That's the starting point.
Got it, based on that immediate theoretical value. And finally, one more. Can a whole rights offering actually be suspended or even completely canceled after it's been announced?
Yes, it can. The Capital Market Authority, the CMA, has the power to suspend an offering at any time if they believe it breaches capital market laws or regulations. If something looks wrong, they can step in. Furthermore, the entire offer will be canceled if the shareholders themselves at that crucial Extraordinary General Assembly don't actually approve the details of the offer, the price, the ratio, etc. Shareholder approval is mandatory.
Okay, so it's not always a done deal until the final approvals are in. That's good to know. Right, well, we've certainly covered a lot of ground there. We've navigated the savvy investor's playbook for rights issues, all the way from the core definitions and the life cycle of an offering through to your critical choices as an investor and those inherent pros and cons. Understanding these dynamics hopefully truly empowers you to make more informed decisions, whether you're looking to protect your existing stake or maybe seize new opportunities presented by these issues.
Yeah, and if we just connect this back to the bigger picture for a moment, it really highlights how a company's financial health and its strategic needs directly intersect with your own individual investment journey. And maybe this raises an important question for you, the listener, to consider. How might a company's frequent reliance on rights issues, perhaps instead of using other financing methods like debt or retained earnings, influence your perception of its long-term financial stability and its genuine growth prospects? Is it always a sign of health or sometimes something else?
That's a powerful thought to chew on, definitely. A great question to ask when you see these announcements. We really hope this deep dive has provided you with clarity and perhaps more confidence in navigating these situations. Keep digging, keep learning, and absolutely keep asking those big questions. This has been The Deep Dive, brought to you by Shares247.com, Home Learning Community, your free go-to resource for empowering financial knowledge. Join us next time for another deep dive into the information you need to stay well informed.